Morning, it's Jeffrey Christian. It's Friday, the 23rd of October in New York, about 10:20. Coming to you when gold prices around $19, $20. Silver's trading just below $25. The markets have been acting as if a variety of problems, political, the election, Brexit, economic, the recessions, trade wars, and the pandemic all are likely to cause pain and suffering, which will be reflected in stronger investment demand for gold and silver, which will be reflected in higher prices. And that actually has been CPM Group's and continues to be CPM Group's main outlook for the next couple months, several weeks. We're 11 days away from the US election. We had a debate last night that actually was a debate. It wasn't a great debate, but it was a debate as opposed to a hot mess. It's still, in my mind, unclear how the election will shake out. And it's clear in all of our minds that we won't know on Wednesday, November 4th morning who won because of the massive amount of mail-in voting that will have to be counted in the days and weeks after that. We have assumed that the markets would be volatile going into and coming out of the election, and we still assume that. One of the things that we've looked at is the risks for political problems and even political violence in the United States, given the devolution that we've seen in the US society over the last 20 years, 30 years, pick a period of time. There is an alternative scenario, which is a big yawn. Somebody wins, it could be either side, and the other side says, okay, that's the way it is. And all of these neo-Nazis running around with automatic weapons stay at their homes, and we just get on with it. In that kind of environment, you could see the precious metals prices come off, at least for a period of time. Gold could drop down as low as 1850 pretty easily. It did last month. But we think that in a longer term perspective, the underlying economic, political, and social and pandemic public health issues will continue to be problematic for the overall economy, financial markets, and that will lead investors to buy gold and silver more and more. So I think that that's worth keeping in mind. I do think that there are any number of investors out there who are saying, well, maybe I should take some profits now or buy some puts in gold and silver in case the prices do spike down. But if the prices spike down, I think I'm going to buy them as buying up, take that as a buying opportunity. I have a presentation here that I'm using next week, and I wanted to run through a couple of the slides which have to do with special topics. We're seeing investment demand rise sharply. These two bars here, 2020 and 2021, are projections. You can see that we've gone through a period of time from 2013 through 2019 when investment demand was really less than 20 million ounces most of the time. We did see a couple spikes over 20 million ounces in 2016, 2017, and the gold price rose a little bit. Then it came down 18, 19, and now it's gone back up as all of these issues have come to surface. And that's why the price is high. Central banks are price sensitive. When the prices rose in 2016, 2017, they bought less gold. When the prices fell in 2018, 2019, they bought more gold. When the price fell in 2020, this is 2020 and 2021, they're buying less gold. And in fact, the only central bank that's buying any significant amount of gold is the Bank of Turkey, which has its own issues for doing that. And some of the central banks like Kazakhstan that have been big buyers for most of this previous 12-year period have actually, some of them have sold, and Russia and China have not been buying for most of this year. I've talked in the past about the big surge in gold and silver ETF holdings and the fact that a big part of the 28 million ounces of gold that we've seen go into ETFs and 300 million ounces of silver going into ETFs actually doesn't reflect investment demand per se. Rather, it reflects gold and silver that was sold by investors to bullion banks, and the bullion banks have sold that metal in exchange for ETF holdings. So we're seeing a tremendous amount of metal build up in the bullion banks' balance sheets exactly at the time when senior management is saying we want to get away from precious metals trading. We want to reduce it or close our precious metals operations. And one of the things that's happened as a result of that is that they've taken some of their gold and silver that they bought by virtue of their being market makers and bought ETF holdings. That's distorted some people's views of investment demand, and they've gotten much more bullish than they probably should have because they assume that the gold and silver that's being bought by ETFs all represents investment demand. A big part of it does, but we're not sure how much of it actually represents a devolution of the liquidity, the depth and breadth of the liquidity in the key bullion market. The next couple charts I want to show you, these are London gold and silver inventories. They only go back to July 2016 when the banks there deigned to start making their data available. A lot of the gold, most of the gold is held at the Bank of England. It's the place to be if you've got gold to store in London. And then the rest of it's held in other depositories, 3 banks and 4 non-bank, non-financial depositories. You can see that that amount of gold has risen sharply over the last really 15, 18 months. And there was a sharp increase starting in March, and it continues to be high. It's a lot of gold, record amounts of gold in London. Silver continued to rise throughout the period into the middle part of this year, and they actually have seen a reduction in the amount of silver held in London vaults, which is kind of an interesting phenomenon that we're looking into. Some of that silver and some of the gold has moved into New York, and these are Comex gold and silver holdings. And again, I should point out, because I'll talk about it in a second, these are 400-ounce bars. This is good delivery 400-ounce bars in London, and these are good delivery 100-ounce gold bar and 5,000-ounce, or 1,000-ounce rather, 1,000-ounce silver bars. And you've seen a big surge this year in the Comex eligible and registered gold stocks, and you've seen a big surge. Well, you've seen a relatively significant surge in silver Comex registered stocks and a bigger surge in eligible stocks. And that surge actually started in 2016. So you have record amounts of gold and silver in the market, in market inventories in London and in New York. And you also have them in Shanghai and Zurich, although the data is not really available. The last chart I wanted to show you has to do with the value of gold bars. And there's this discussion going on because a lot of investors are buying a lot of gold and wealthy investors are buying kilobars. And there's a tremendous demand for kilobars, and there's a very healthy premium for kilobars over 400-ounce bars in London or even 100-ounce bars in New York. And it's very interesting because you have people saying, why don't investors want 400-ounce bars? They only want kilobars. And the answer is the price. When 400-ounce bars were made standard during the classic gold standard day, the prices of gold officially were $20.67 or $22, depending on which country you were in. And a 400-ounce bar cost $8,800. After gold prices were free to float in 1933, they moved up to about $35 an ounce. And the official price of gold was $35 an ounce in the late 30s through World War II. And then it was fixed at $35 an ounce by Bretton Woods from 1945 until 1971 on an official basis, when it was raised to $42 on an official basis. It was free to float in the private market in 1968. But at $22 an ounce, a 400-ounce bar was $8,800. At $35 an ounce, it was $14,000. People could afford that. At today's or this month's price around $1,900, that 400-ounce bar is $760,000. And certain people can afford that, but a lot of people can't. So if you're an investor and you're buying gold, and unless you think you're going to hold that gold forever, one of the thoughts you need to have, and one of the things that CPM Group works with its investment clients on, is what do I do when it's time to sell? How do I decide when it's time to sell? And how do I sell it? And one of the things you realize is it's a lot easier to sell kilobars, and it probably will be a lot easier to sell kilobars in the future under at least 2 of the 3 scenarios, and probably all 3 scenarios that you come up with. Rising prices, falling prices, prices staying the same, depending on why they're rising or falling or staying the same. But it's probably going to be a lot easier to sell kilobars in the future when you want to. And the depth and breadth of the liquidity of potential buyers for kilobars is greater than 400-ounce bars. You don't have to find somebody who has $760,000 or whatever the price is at that time to pay for a 400-ounce bar. 400-ounce bars are great if you want to stack them up and keep them for a long time, the way central banks did during the gold standard days. They're great if you want to ship them back and forth because you're using them to sell your international trade and capital flows. But they've gotten a little bit too pricey for most investors. And it's kind of funny because there's this discussion about why no one wants 400-ounce bars. And it really comes down to a matter of the price, which leads to a matter of liquidity. Anyway, that's one of the things that's been bumping around the market for a few months, few weeks. And I thought I'd mention it today. Other than that, that's it. Sit tight. We've got 11 days until the election, and then there's Brexit to pay attention to. And I'm sure that the US government will find something else for us to worry about, even after the election is done and settled. In the meantime, stay clean, stay safe, stay healthy, take care of yourself, take care of others, and I'll talk to you next week.